friends, welcome back to the channel. So guys, in today's video I want to clear the air once and for all. How can corporates or people working in corporate sector can invest their salary so that they have very secure future? How can corporate people invest their salary? And my objective here with this video is to give them a roadmap to attain financial freedom, right? This is what we are after, right? Financial freedom. So in this video I'll give you a step-by-step framework on how you can invest money, and more importantly what you'll be learning is how you can make money all the time and take advantage of all the asset classes which are existing in the investment sector, right? So just to give you a brief background, I have a full-time corporate job. I am somewhere working in the middle management. I have a salary of close to 25 lakhs and I invest monthly, right? And I will be sharing here what I'm learning on a day-to-day basis. I'm very fascinated by great investors like Warren Buffett and Benjamin Graham. So in this video, I just want to particularly keep it limited to people who are investing their salary. So let's say if you're making close to 2 lakh rupees per month, right? So the most important thing what you have to keep in mind is you invest at least 50% of your salary, so if you want to, especially if you want to retire, and retire wealthily so that you can just sit on the beach somewhere and money should keep on multiplying automatically while you're still drawing money from it, you have to keep at least invest 50% of your salary. And this is something which is very clearly mentioned in the book Richest Man in Babylon, right? Amazing book, guys. If you're in the corporate sector, read the book. This book is a common guy in Babylon who became the richest guy, and he followed some very simple laws which most of us ignore, right? And in that book, the most important rule or law to follow to become rich was pay yourself first. Now, what does this mean? Does anybody of you know what does this mean? Most people would have heard this, but nobody exactly knows what this means. So pay yourself first is such a deep and such a profound concept in becoming wealthy and becoming rich, that if you just follow this, then you will by default become rich and nobody can stop you and your generations to enjoy your wealth. So it basically means pay yourself first. As soon as you get any salary or any profit from any business, if you're into a business, you draw a certain section of it and don't look at it. So for example, if you're making 2 lakh salary like we have seen here, right, you take 1 lakh out, you don't even look at it, you pay that to yourself rather than paying to grocery, or rather than paying to your mom or your spouse or anybody else, or for your bills, electricity, etc. No, that all comes later. You have to pay 1 lakh of this 2 lakhs, 1 lakh to yourself, right? This 1 lakh to yourself, to you have to pay first 1 lakh, right? And this is what it means by paying yourself first. So now you will be left with what? You'll be left with 2 lakhs minus 1 lakh which you have given yourself equals to 1 lakh. Now this is your actual income which you have for your spending. Now you can spend it for all sorts of things. You can pay your bills, you can pay the fees for your children, you can pay the fees for whatever, right? Fees for your yoga classes, or you can give it to your spouse for household spendings, etc. Right? So this is what is meant by paying yourself first. Now once you have, and I'm taking here the example of 1 lakh, you can it depends on your salary. So if you have very less salary, at least carve out 30% of it, and if you're not able to carve out 30% of it, then work very hard to increase your salary, guys. As simple as that, right? But at least 30% of your salary, if you want to get rich with your salary so that you have generational wealth, you have to pay this amount to yourself, right? 30 to 50%, right? But to keep things very simple in this video, I will take the example of 1 lakh. Let's say you make 2 lakhs and you are able to uh, uh, invest 1 lakh which you are paying yourself, and remaining is 1 lakh which you have for spending, right? So what will be how you will be spending this 1 lakh or 100,000 rupees, so that you can have generational wealth, right? This is going to be very, very important, guys, and believe me, this is the crux of my knowledge thus far, and I just explained it to my boss, right? She is making a salary over 1.5 crores, right? But she has no idea of how to invest it, and believe me, she has never paid herself first, and she doesn't have any money. So this is my honest attempt to give you that framework, how I explained to her, right? So what I'm gonna do now is I'm gonna draw a pie chart, right? What does a pie chart mean? Consider this as a pie, and this basically denotes your 100,000 rupees, right? Now how will you invest this 100,000 rupees, right? So you have 3 main asset classes, which is equity, debt, and gold. There are many other asset classes, for example commodities, right, and currency. But to keep simple and to keep things for the common man, I will not touch these, although gold is a commodity, but only one commodity I'm considering here, right? And there's crypto and all, which again comes in currency. Stay away from these guys. These are, I want to consider here assets. Most of them have an intrinsic value, right? So that they have a value in the market, and I want to keep the game very simple for you. So this is going to be my recommendation, right? So in this pie, now we have to divide 100,000 rupees among these three, right? So now this equity, equity proportion, I want you to keep 50%. And don't question this, guys. This is the best which has worked out for me, and I want to give you this framework simply so that you can blindly follow this, right? I want you to keep debt as 30%, and I want to keep gold as 20%. And later in the video, I'll tell you exactly how to buy these and where to buy this. Equity, debt, and 20% gold. Okay, simple. Now why I'm giving this fraction to you? Okay, so just understand these 3 graphs. So first is first is your debt. Okay, so debt, by the assets which I'll be telling you will get anywhere between 6 to 9% returns on your investment. 6 to 9% consistent returns. There will be very less volatility here, but it's going to be pretty or more consistent. In gold, which is going to be a 20%, you'll get again 7 to 8% returns. But here again, it's going to be like this kind of a graph, right? There's going to be some volatility. In equities, I'll just get it here. In equities, and this is overall equities I'm telling you, by the kind of asset classes which I'll be telling you, if if we continue to grow like the Indian economy is growing, we'll get anywhere between 12 to 18% returns. Okay, simple. So 12 to 18%, but again here the returns are not going to be linear. Like here they're going to be shaky, so it's going to be like this, right? Like this. But overall, if you have the moving average, it's going to be 12 to 18%. Understood simply? So your money overall will be growing at a rate of close to 11 to 12%, right? Close to 12%. Now this is because of the fact that your equity is considering the biggest proportion. Now why have we divided these into 3 asset classes? The reason is just by doing this, you have done something called as all weather investing. Okay, all weather investing. This is whether it is raining, whether it is a thunderstorm, or I'm really poor in here in drawing, or whether it is a sunny weather, right? You're making money in all weathers, right? And this is very important for a common investor. What is the problem with a common investor? As soon as the common investor sees a drawdown in their portfolio, right, in equity, they become shaken, they pull out, right? By doing this proportion, what I'm telling you, you will ensure that your portfolio is always in green, it is always going up, and right, although it will not be growing if you are taking 18% at all the times, but it is growing at a considerable high rate, right? In all weathers, whether it is down market, whether it is up market, whether it is a bear bull, whatever, you don't have to worry about whether there's a nuclear war going on. You will be safe. And another reason is, one very important reason which most people overlook, they say a lot about Indian economy, right? India is a developing economy. Our GDP is growing at 7.5 to 8%, right? We are a developing economy, and we should be following the path like US markets have followed. But nobody knows for sure what's going to happen tomorrow. We can very well have a scenario like China or Japan, where if you see the market of China and Japan, it is something like this, right? And for last 20 years almost, we have not seen a growth where we were 20 years back. So it can be a very well case for India. It should not be. There's just in my opinion, hardly less than 5% chance that this might happen. But if it happens, you will be safe here. You will be safe here. You'll not lose any money. Money will be growing here, right? And equities someday in the future will definitely turn up, right? And why it will happen, there's a reason for it why it happens. Equity will never go down. Warren Buffett has explained this. I will keep it for another video, but just to give you a brief idea, even if there's a nuclear war tomorrow, entrepreneurs will come up, solve problems, create companies, the world will buy products, and we will have market cap increasing. That's why the economy will always increase, right? And equities will always give you good returns. Now, once you have divided this, made this pie chart, I'll just delete it here, right? That I can write. Once you have made this pie chart, in what exact asset classes will you invest and where will you invest, right? So I'll just give you some details about that. So it's very simple these days, guys. I mean, you can have wealth on automation. Basically, it's as simple, believe me, right? It's not, you're not living in an ancient era, and this is for corporate people who don't know about investing. So first, equity. Now equity is big, right? Equity, there are a lot of investment instruments available these days, but for corporate people, so just to give you a brief idea, you can invest in something called as funds, or you can invest in individual stocks. So for investing in individual stocks, you need a broker's account. So you need to open up a broker's account with brokers like Zerodha or 5paisa or ICICI Direct, etc. Zerodha and 5paisa are discount brokers, meaning they charge very less brokerage, low brokerage, right? Well, these big fund houses like ICICI Direct and Edelweiss, they charge a lot of brokerage, so avoid them. Go with the discount brokers, right? If you want to go with the individual stocks, but I would definitely not recommend you to go with the individual stocks. What you should be doing rather instead is going with the funds, right? Now, what is a fund? So let's say in an individual stock, you're buying a particular stock, but in a fund, you're not buying any particular stock. You're buying something called as a basket of stocks. Consider this as a basket. So there will be like 20, 30, 40, 50 stocks in this, right? So the chances of you not failing are nearly impossible, right? And why am I saying it is impossible? So let's say you have a stock worth 100 rupees. What is the maximum it can lose? 100 rupees. But what is the maximum it can give? It can become 1 lakh rupees, right? So simply your upside is unlimited. Your upside is unlimited, while your downside is limited. Okay, so let's say if you buy any individual stock here, right, and it goes to zero, so you lose all your money. But when you buy a basket, even if 80% of the stocks in your basket fail and your 10-20% will rise, right, it can more than compensate for this downside drawdown, because the upside is unlimited. This is a very important concept to understand. Okay, so always buy funds, right? And most cases 80% will not be good, because you'll be, the way I will tell you, you'll buy good funds where a lot of stocks 80% will be good, so you'll make a lot of money. Okay, now what are these funds? How many types of these funds are there? So there are two main types of funds. First is called as the passive fund, and the second is active mutual funds. So passive mutual funds and active mutual fund. Now what does this mean? So we have something called as an index in India. So we have two stock exchanges, National Stock Exchange and Bombay Stock Exchange, right? National Stock Exchange has an index called Nifty 50 and Bombay Stock Exchange has an index called Sensex. So what are these Sensex and Nifty 50? So Nifty 50 are the top 50 companies in National Stock Exchange who are so let's say if there are 5,000 companies listed in National Stock Exchange, out of that top 50 companies are in the index. Okay, and how these top companies are selected? Based on the market capitalization, market cap. So it is total number of shares. Let's say if they have 1 million shares, into the price of each share, and whatever number comes, let's say it comes out to 100 crores, and this is the market cap. So for example, HDFC Bank, ICICI Bank, these are all the companies here in the index, right? And the index has representation from all the major sectors. So pharma sector, FMCG sector like fast moving consumer goods, for example Hindustan Unilever, or here Procter Gamble. These are the companies of FMCG sector. Parlin, Marico, right? All these companies. Then you have banking and finance here, right? Banking and finance sector. Then we have a lot of other sectors. For example, we have auto sector, automobile sector, right? So all these sectors have representation in Nifty 50, and in these sectors the biggest companies are in Nifty 50. Now Sensex is the likewise the index of top 30 companies. So whatever the top 50 companies of Nifty 50, they are already there in Sensex. As simple as that. So that's why you will see in the news that Sensex will closely follow Nifty 50 because this is a market cap weighted index, right? So anyway, whatever 20 companies are remaining, they constitute a very less proportion of Nifty 50 because their market cap is too less, and the company which has the highest market cap has the highest proportion in the Nifty 50 index, right? So I hope this was clear to you. Okay, it was important to explain here, then only you will understand what are passive mutual funds and active mutual funds. Okay, so simple. Now, if you have understood this, then what is the meaning of a passive mutual fund and what is the meaning of an active mutual fund? Let's get that clarity. So, a passive mutual fund is a fund which does not do any research, any stock analysis. They do nothing basically, right? What they simply do, they take money from you. So they'll ask you money. So you'll give them coins or notes or whatever, and they'll simply invest in Nifty 50 or whatever index they're following blindly. Like if Nifty 50 is having 50 companies, they'll just pick those 50 companies and invest in the same proportion. So for example, Nifty has 20% HDFC Bank, 0.1% Marico. They will just select that blindly and they will put your money over there. And since they don't have to do any brainstorming, they will charge you a very less fees, which is called as the tracking error, which is the fund management fees. So if you just think about the tracking error of passive funds, it is close to 0.05% something, right? Very less. Well, active mutual funds take your money and they do stock research. They don't blindly invest in index, right? And they want to generate something called as alpha over the index. So if index is, let's say, giving you 14%, they want to generate like 22%, which is 6% alpha over index, right? 8% alpha over index. So they do active research, and as a result, their fund management fees, which is their expense ratio, is higher. So their expense ratio is now close to, let's say, 2% or 1.5% or 0.75 to 2%. It varies fund to fund. So you always should keep this in mind, that your expense ratio should be less while selecting your mutual funds, right? So this is, I hope you got the idea. So I want to keep this video very simple. We are not going in individual stocks, we are going in funds, right? And I will tell you how to now select your funds and what kinds of funds to invest in. Okay, so now once you understood this, what are the funds, now you have to select these funds. So what you have to do is you have to select something called as a large cap mutual fund. Right, this is the first one. Second is mid cap mutual fund. Third is a small cap mutual fund. And you have to select one Nifty 50 index fund. Okay. And fifth, which you have to select, is Nifty 230 momentum index fund. So for example, if you have 1 lakh to invest, we just take that example. You are now investing 50,000 in this, right? In all this. So you are investing 10,000 in each. Okay. And this basically wholesomely diversifies your portfolio. So large cap mutual funds will only have large cap companies, and there's so many large cap mutual funds. For example, we have Nippon, we have HDFC large cap. You go to any mutual fund buying platform like IND Money, Grow, Zerodha Coin, you can buy these mutual funds, right? HDFC large cap, Nippon large cap. Don't worry about, they will, on the long run, they'll more or less have the same returns. Okay, keep that in mind. Then the mid cap mutual fund, likewise you have to, these are mid cap companies, the market capitalization is not very high but lesser than blue chip companies. So the volatility of large cap funds will be less because they are blue chip companies, they are good companies, but their growth will also be not very high. But in mid cap companies, which are medium companies, they have a lot of scope for growth, but here volatility will also be high because they they are not very established, they are just growing companies. Likewise is more the case with small cap companies. So there the market cap is like 500 crores to 1000 crores, right? Just by for example I'm telling you. So here small cap companies, again, they have a lot of potential to grow. 500 to 5000 crores they can grow, like 10 times growth, right? But they will have a lot of volatility also. So for example, if you take a new CDMO versus an established CDMO, new CDMO will have a lot of potential for growth, but one change in policy can destroy their business also for years. So volatility will be there. So this is a simple concept, right? But you want to cash on all these three. You want to take the advantage of stability of large cap with less growth, and you want to take the advantage of high volatility. The overall your volatility will be low if you buy these three, and you're taking advantage of the growth of all the three, right? So this is the one diversification. Now Nifty index, I want you to also buy the index. So if any of the mutual funds does not work out, your index should work out. So this is a diversification we're putting in place, right? Right. And mostly also the reason I believe in index is because Indian economy, whatever is happening, is a remnant of what has already happened in US. And in US we have seen it's a very mature economy that 99.99% of the index funds have not been able to beat them. 99.99% of the mutual funds have not been able to beat the index, which is S&P 500, right? So we always keep ourselves secure and put 10% and this 10,000 in Nifty 50 index. Now I also wanted to include one momentum index. Since we are living in a very somewhat advanced market now in India, we have an instrument called Nifty 230 momentum index. Now what this index is, it's an index existing, and there are index funds existing, right, for following this index. So what this index does is, from the top 200 companies in Nifty 50, there's a Nifty 200 index, right, which includes 200 of the companies in Nifty in Bombay Stock Exchange listed. This takes top 30 of those which are the highest momentum companies. This does not care about market cap, nothing, no stock analysis. They just have a momentum index which is the growth rate, and every 6 months they keep on churning this basket. So historically it has been seen that this provides a return of 25% compared to 14 to 15% in Nifty 50. So this will give you the growth. I mean, this 5 things, you don't have to worry about any stock analysis, nothing. These 5 things you blindly invest, and over 20 years you will be effing rich, right? Let me just simply put it like this. Now this is what I wanted to give you, the equity side of it. Now I want to give you the, and this is how exactly I explained to my manager who had no idea, guys, how to invest. Now I want to shift gears, and we have covered completely equity, right? You got the idea where to invest, how to invest. By the way, comment section is wide open, just put it everything over there. Now I want to help as many corporate people like this, like me, who are suffering, and help them out exactly, in buying the right asset classes so that they can actually retire in Goa, live on the beach, have a pina colada with alcohol, not the virgin one, and enjoy the beach so that their money is automatically multiplied, right? Now the second, how will you provide stability? Gold, right? How will you buy gold? You don't have to buy the baskets of gold. You have to buy paper gold, and you don't even have to buy paper gold. You have to invest in asset classes which replicate paper gold, right? So if let's say the prices of gold increase by 7 to 8%, your asset, which is your paper bond, will also increase by 7 to 8%. And there are funds existing which basically buy this bond. So that funds rate, those mutual funds, they're also called mutual funds, right? Gold mutual funds, they will also reflect 7 to 8% growth. So what are some? So if you go to again any platform, IND Money, Grow, Zerodha, Coin, and you search for gold mutual fund, you'll get a lot of. You just buy any one of those. SBI has one, HDFC has one, Birla has one, right? So you can buy any of those and put your 20%, meaning if you're investing 1 lakh, 20,000 rupees of gold mutual fund, right? Simply, don't think over it, simply blindly do it, right? So gold is clear. If it is still not clear, let me know in the comment section below. The third thing what you have to do is you have to buy debt. Now what do I mean by debt? Debt is again bonds. So we have something called as fixed deposits, which we know about, right? You deposit a money in bank and they promise to give you a return. Likewise, we have something called as bonds. So corporates and government are asking you to give them money, and they will give you something in return called as bond, and they promise to give an interest of 7 to 9% on that bond, 6 to 9% on that bond, depending on the bond, right? So they can be short-term maturity bonds, they can be medium-term maturity bonds, and they can be long-term maturity bonds. Okay, so now the short-term maturity bonds have their maturity in 1 to 3 months. Okay, so their interest is less. They are called also overnight liquid. They are called as liquid funds or overnight liquid funds. So they are very liquid funds, right? So they have annual return of 6%, close to, not exactly. It can be 5.5 to 7 also. And medium-term maturity fund, they are also called as ultra short duration bonds or ultra short duration funds, which are buying these bonds. The mutual funds which are buying these ultra short duration. And again here the maturity of these bonds are 3 to 9 months. And then we have long-term maturity bonds, which are generally bonds of RBI, Reserve Bank of India. Long-term maturity bonds. So here if you see in the liquid funds, ultra short duration funds, and long-term maturity bonds, the rate of return increases from here to here. So it goes from 5.5 close to 9% closely, right? And the mutual funds which are buying these bonds are again named as by these bonds. So mutual funds which are buying liquid the short-term duration bonds are called liquid funds. Mutual funds which are buying medium-term duration bonds are called ultra short duration funds, and mutual funds that are buying long-term maturity bonds are called gilt funds, right? Which are the most secure and they park your money, but there is some little bit of a volatility. So what I want you to do, sorry for this mess here, I will make a follow-up video if you request me to have a sorted one, but I just want to let it out, guys, in this one. Okay, so what you have to do now is you have, I told you to have 30% of your money, which is 30,000, invest in debt. So this is how you will invest this. You will invest 10,000 in liquid, you will invest 10,000 in ultra short and 10,000 in gilt. Now why I am saying this, let's say if you need 20,000 after say 3 months, you can very well have this one, pull out the money from this one. Let's say you want to pull out, you need some 30,000 rupees after 6 months. This is the best one because you'll get the maximum return, and for the long one, this one, right? So always have this mix, guys. This is anyway to provide stability and ready availability of cash to you. Your growth is coming from here, equity. So you don't have to worry about it, right? Equity and gold, this is just for you to provide peace of mind, this part, and ready cash whenever you need it, right? The growth will come from here. Now if you just follow this and if you compound your wealth at 14 to 16% by for a lot of time, so you follow the rule of 72. Rule of 72 says whatever rate of return, so let's say you get 16, so 72 by 16 is how much? 72 by 16 is 72 by 16 is 4.5, right? So what this means is that if you're growing this at 16%, you will be doubling your money in 4.5 years. Okay, let's say you work for 25 years, right? So how many doubling times you have? You have 5 doubling cycles, right? 5 doubling cycles. So let's say if you start with 1 crore, right? In first doubling cycle, how much your money will be? 2 crores. Second doubling cycle, 4 crores. Third doubling cycle is 16 crores. Fourth doubling cycle is 32 crores, right? This is the magic of compounding, guys, which you will be taking if you will invest in this simple thing, and you don't have to do anything. You have to just take care of one thing, which is pay yourself first and become ultra wealthy. You will be a ultra high net worth individual, right? Okay, so I'll make a follow-up video if you need me to, with more tidiness, right, on this topic. If not, then I'll select a topic of my choice. Let me know in the comment section below, guys, what more videos you want me to make, and if not, I'll select a topic which is there in my mind, right? On this channel, I am increasing my knowledge about finances, and I'm sharing here what is helping me out. So I'm no guru, right? I'm just like you, but I may be a step or two ahead of some of you, or a step or two behind some of you, but just consider me as someone very much like you. Thanks again for watching the video, guys. We'll see you again in the next one. Till then, take care, bye bye. And if you're new to the channel, don't forget to subscribe. Bye bye.